The Fed went big with an interest rate cut, and I want to have a conversation with y'all based off of what that means. We're going to cite our sources and use the Wall Street Journal, and then we're going to leapfrog off of that, and we're going to apply it to our lives. Make sure y'all hit a like for the algorithm, subscribe to the channel, and turn on your notifications. Let's get it.
The Federal Reserve has been climbing a mountain to
Shout out to
combat
Jay.
stubborn inflation so fast that it raised its benchmark interest rate 11 times in 16 months, then left it unchanged for more than a year. But now...
So, before we get into it, why are interest rates important? Because I don't want anybody to be left behind. I know that if you're a bag chaser, okay, then you may be a little bit more informed than everybody else. But when it comes to the money and when it comes to running up a bag, we don't shame people. We educate them because we are stronger together than we are apart. When people hit me up and they say, Anton, what is it that I can do for you? Because you changed my life. You helped me get a bag. You helped me land this job, interview like a king, mastermind sessions, whatever. I said, the best thing that you can do for me is continue to pour into yourself. Why? Because I can't use you unless you get into the bag or you have some level of significance. Then we can leverage each other to continue to be great, right? That's what's called networking. That's real networking. Pouring into each other so that we all can become successful, and then we use each other to become greater in a positive way, right? So when we having these conversations, and I know we're not going to deep dive into bag chaser territory because that's way different. That's money on a whole nother level. When we have these conversations, we're looking to educate. So don't shame people if they ask questions. Don't shame people. We want to, inform them. Interest rate cuts or rising interest rates, as illustrated on this graph right here, during the Kamala Harris-Biden administration's reign in office, you seen and you felt the impact of it in your daily life. As a matter of fact, a lot of y'all felt it even worse because your lifestyle, depending on how much you depended on credit cards, paying certain mortgages, going to buy a house, goods and services, logistics, moving stuff back and forth. Kamala Harris wants you to believe that building 3 million more houses is going to somehow lower the cost of living and value, right? It's not true. You're not going to flood the market and think that that's going to change anything. It's 1.7 million houses that's for sale right now, right? And so when inflation exploded, because they weren't able to effectively manage our economy and they went against everything that Trump did, what happened was, in order to tamp down inflation, they raised interest rates, right? Raising interest rates made it more difficult or more expensive for you to borrow. And this affected commercial loans. This affected your interest rates when it comes to credit cards. This affected when you went to buy a house. This affected, when you went and bought a car. Every single thing. But every business is affected by it because America runs on debt. Our banking system is largely based off of debt. So if money is more expensive, it makes it more difficult for you to do business. I'll give you an example. You notice how all of the real estate gurus somehow disappeared? You notice how foreclosures went up, evictions went up, all of that? Because it was much more expensive for you to acquire more doors, meaning that it was more expensive for you to buy additional properties. And a lot of people lost their faces. They lost out of their earlobes because they went and bought these properties, right? And they couldn't sustain it or they couldn't make it work from a financial perspective. Why? Because as interest rates rose, it made it more expensive for you to borrow, thus making your mortgage more expensive. Your property taxes also went up on top of that. Insurance was higher. And in some states like Florida and California, insurance companies pulled out altogether. So now what they did was they tried to pass all of those costs over to the consumers. When you go to the grocery store, they pass that cost over to the consumers, right? When it costs them more to do business. In California, they raised cost of living much higher by obviously raising the minimum wage. And they saying that everybody deserves, to be able to feed their family, even if you're just flipping fries. Well, they pass that cost over to the consumer. And so prices gradually rose and then borrowing became harder or much more expensive. And even when it came to renting properties out, or you as a lender or you getting a mortgage, it was way more expensive than it was back in 2019, 2018, 2017. And so all of the real estate gurus disappeared. Why? Because they couldn't pass that cost over to the consumer because you couldn't afford the rent that they needed to charge in order to even break even, let alone be a cash flow property. If my total costs, mortgage, insurance, property taxes, and I haven't even factored in future maintenance for the property equals A, and you can only afford B, what you seen on TikTok was a bunch of people saying, man, they want 3 months rent or 2 months rent or whatever, so on and so forth, right? They want first month's rent plus a security deposit equal to first month's rent or whatever. And I can't afford it because I don't have $6,000. I don't have $7,000. I don't have $5,000 just to be able to move in. And then I have to cover all of the utilities, all of the expenses, whatever it is that's associated with the cost, and feed my family and go to work. I can't afford it. I can't afford it. You were not able to pass that cost over to the consumer because it cost you too much money to borrow. And so in order for them to tamp down inflation, they had to temporarily, that's why you see the graph right here, temporarily cost more for you and then force you basically into suffering. That's what y'all not really taking into consideration. I've said this. I told y'all years ago, I said, listen, y'all, interest rates is about to go up in order to tamp down inflation because they don't know how to manage our economy effectively. Y'all gonna suffer as a result of it. It's gonna be layoffs. Cost of living is gonna go higher. You're not gonna be able to do this. You're not gonna be able to do that. Oh, Anton, no big deal. I don't really care. Okay, well, this is what happens. Now they're doing rate cuts. They did a 50 basis point rate cut. What 50 basis points means is they did a 50%, oh, not a 50%, I'm sorry, a half a percent. If it's 25 basis points, it's 0.25. If it's 50 basis points, it's 0.5, right? A half a percent rate cut. Why? They're lowering interest rates in order to get the economy back humming after they did an artificial clamping down of inflation because they didn't know how to run the economy effectively. So now they're trying to make borrowing easier, and so they're easing back into lowering interest rates before the election so that they can make it easier for you. We don't have a housing problem of building 3 million more houses. So when she jumps on these platforms and she just talks, she's talking out of the side of her head. We don't need 3 million more houses. You don't need artificial manufacturing, you just want to incentivize, right? So you don't need to push people to do things. You just need to make it affordable for them to be able to make the decision for themselves. You don't need 3 million new houses, 1.7 million houses available for sale right now. People want to sell their houses that's not even available for sale, but they can't because they know that if they refinance or they go and buy another house and they're going to finance at a higher interest rates, which makes it much more unaffordable. So they might as well stay where they at. They want to move, they want to go somewhere else, but they can't because their interest rates is too low that they got when they was under Trump. And then at the same time, they can't go based off of these interest rates because it don't make sense financially. So they're not going to pull the HELOC out. They're not going to go out and spend money. They're not going to renovate. They're not going to do all of these things that would obviously keep the economy humming because we don't have economists. We don't have real people that's running the White House. So now they're easing down the interest rates to make it cheaper for you to borrow money, cheaper for you to go buy a car, cheaper for you to go and get a house. And it's not all the way cheaper. It hasn't gone back. I don't think we'll ever go back to the interest rates of 3% or 2% right now. But they're making it easier because the commercial real estate industry is going boom. It's going bust. They suffering. They need to refinance their loans in order to survive. Houses ain't moving because we have an unaffordability problem. We don't have a housing crisis. We have the fact that people can't afford to buy the houses that they want to buy and live in it. That's the real issue. So they're lowering the cost of money prior to the election, and they trying to see how they can make it shake so that they can act like they fixing the economy.
Now,
the committee decided to lower the target range for the federal funds rate by a half percentage point.
Now is a make or break moment for the Fed.
while prices have cooled, an uptick in unemployment has reignited warnings of
a recession.
And so the question now is, can they stick the landing?
The central bank likes to keep inflation around 2%. That became a problem in the aftermath of the pandemic. Prices grew well above the 2% mark, eventually surpassing 7% in 2022.
For most of us, for a lot of us, it was above 10%. For most of us, for a lot of us, it was above 10%. Inflation year over year was 10%, 10%, 10%. It wasn't just 7.1%. It was up to 10%. It was above 10% for a lot of people, depending on what their lifestyle was.
For the last 2 years, inflation was the big emergency that was occupying all of the Fed's attention. When the Fed was raising interest rates, they thought the economy was going to have to slow down a lot more than it has.
I wish there were a completely painless way to restore price
Now remember,
stability.
this is in 2022. This is December 14, 2022, right in the middle of what Biden and Harris was rocking out. Listen to what he's saying. Listen to what Jerome Powell is saying in December 2022. I'm going to rewind it for y'all.
I wish there were a completely painless way to restore price stability. There isn't. And this is the best we can do.
And what's happened is
they predicted, they told you it's going to be some slow singing and flower bringing. Y'all going to suffer. You going to feel the pain for it. Now, they not going to lose their jobs. They not going to have higher cost of living. They're going to be fine. They're going to be just fine. He told you, hey, man, listen, it's going to be some slow singing and flower bringing. Y'all going to suffer. Y'all ignored it, and y'all still voting for the same thing.
the economy's done pretty well, and inflation's come down anyway.
By July, the Fed managed to bring inflation closer to 2.5%. And with
Now, wait. Look at the graph, y'all. Look at the graph. Look at 2018. Look at 2019. Look at where inflation was at that time. Food, energy, and all items. Look at where inflation was, where we had, look at the graph will tell you the difference between what was happening in 2016 through 2020 versus what was happening in 2020. When Trump handed over the keys, it was at the lowest ever. It was at 1.2% when he handed over the keys in the beginning of 2020.
is easing, economists have turned their attention toward troubling signs in the labor market. The U.S. economy added 142,000 jobs in August, a slight rebound from the summer's slump in hiring, but a notable decline from a year ago.
The cooling in labor market conditions is unmistakable.
It's harder to stop a rise in the unemployment rate once demand for workers has cooled. I mean, what you're seeing right now is businesses saying we just don't need workers the way we did a couple of years ago.
The Fed can try to avoid further erosion by cutting the federal funds rate, or the rate that commercial banks pay when they borrow from each other. Those cuts, in turn, can lead to reduced rates on loans, meaning lower borrowing costs for consumers in the...
I've already kind of explained this to you guys. So I'm going to go over to the Fed split opinion.
Fed officials have largely agreed on the path forward since June 2022, but in recent months, two routes down to base camp have emerged.
Earlier this year, you heard a lot of people saying, look, this economy's doing all right. The economy's adding jobs, the unemployment rate is at a historically low level. Why rush this? You have a Fed Governor Mickey Bowman, the Kansas City Fed President Jeff Schmidt saying,
I still believe quite strongly that we really need to trend this inflation number towards 2. It has to be sustainable.
the danger is that if the labor market starts to weaken a little bit more, it could weaken a lot more, and then you're having to cut more aggressively.
The other camp argues more aggressive rate cuts could preempt a serious decline in employment.
Now that you have the labor market slowing down, these people are saying, let's get ahead of this. Let's not have a recession that isn't necessary to finish the job on inflation. There have been a number of Fed officials, the Fed Governor Adrian.
No, what they're saying is it's election season, and so we need to start having a conversation about how people are truly being affected so that we can promote our economic plan, Kamala Harris, and they don't want to look bad going into November. And so instead of finishing y'all off and kicking y'all asses like they have been, they said, you know what? We're going to go ahead and make borrowing a little bit cheaper and tell y'all that we lowering interest rates as a talking point.
Brianna Kugler, the Chicago Fed President Austin Goolsbee, who have been more insistent in saying,
we've got to keep our eye on the employment side of the mandate now. This is what the path down to 2% inflation looks like.
The danger, of course, of going too fast is, well, what if some new shock hits the economy and inflation kicks back up? That would be very destabilizing to have interest rates go back up, for the Fed to say, whoops, we cut too much. We need to start climbing this mountain again.
The Fed announced at its September meeting that it would cut rates by 50 basis points, starting on a faster path down the mountain.
We thought about what to do, and we concluded that this was the
Now remember, this was yesterday. I told y'all yesterday, or I told y'all at the last stock club over the weekend, that I will be paying attention to the upcoming interest or the Fed announcement of whether or not they were going to cut interest rates, and what my expectation was. And I said my expectation was for them to cut it 50 basis points, which is basically 0.5%, which is exactly what he did yesterday on September 18th. So I was watching this after I got off the live stream. I was watching this to pay attention. And we're going to have this conversation when we do Real Estate Club. And I'm expecting to do Real Estate Club within the next few days. So I'm going to announce that inside of the Patreon also.
right thing for the economy, for the people that we serve, and that's how we made our decision.
A 50 basis point interest rate cut signals more urgency here. They raised rates a lot, and they raised rates in large increments on the way up. And so now that inflation seems like it's under control, but there are more risks of a bigger slowdown in the job market than they want, they're going to take back some of those interest rate cuts more rapidly too.
But I think you can take this as a sign of our commitment not to get behind.
And so there'll be big questions now around, well, do you expect to do this again in November and in December and early next year? How fast do you think you're going to take back the interest rate increases that you made in 22 and 23?
As the Fed charts its way forward, a lot remains at stake for the economy and Powell in the months ahead.
It would put Powell on the Mount Rushmore of central bankers if he can stick the landing. Is the economy just going through a soft patch? Or is it falling into the recession that has been long predicted by many economists? The next 6 months could be pivotal to determining which of those we're seeing unfold here.
So we'll talk about this inside of Stock Club. I'll keep an eye on what's going on. And then or inside of the Patreon, I'll keep an eye on what's going on, and we'll also discuss how it's going to affect you. And even whether or not you should buy a house at this time or you should wait for more interest rate cuts. Because what we're trying to figure out is what's going to be the balance between more people putting their homes on the market, more people deciding to purchase homes, all of that stuff. So we're going to get into that. I love you. I appreciate you. I really do. I appreciate y'all. Let me read a couple of more of the super chats.